Hello friends, welcome. Friends, today I have brought before you a video which is going to be pretty important. And friends, I have really taken a lot of pain to accumulate this data, and I'm going to make things as simple as possible from the point of view of the viewers to understand. So watch till the end of the video if you really want to gain any value from this presentation, and also try to watch this video over a desktop computer, because the mobile phone screens are sometimes very small and it will not be able to do justice to the data that I am trying to demonstrate over the screen. So the real question that I'm asking today is a very important one. Can RBI lower interest rates at will? Right? And why do we care? The reason we care is that the interest rates makes loans cheaper. It empowers our ability to spend. Like we can buy houses, we can buy cars, we can actually make our businesses more prosperous, because we will have high liquidity. Because when the interest rates falls, then our ability to borrow increases significantly, because we don't have to pay interest on our borrowing to an extent that we have to pay when the interest rates are high. Therefore, the common man, businesses, and the economy cares if the interest rates are low. So it's quite natural, and therefore the government has been trying their level best to reduce the interest rates so as to give impetus to the economy. Because as the liquidity in the system increases, more money is into our hands, we become more and more prone towards making investments, making all kinds of necessary expenditure, rather than saving monies in bank. Because if the rates are high, then we tend to save rather than making real practical use of that money in terms of consumption or spending to expand our business. That is in short. Now, in order to understand this whole concept clearly, I have created some charts. So I'll take you through those charts so that you understand these basic concepts before I go into the detail and before I go and share with you the detail, the real data that I'm going to show you as we progress in this presentation. Now, the first slide, which is very important, which is fundamental to understand how the banking system works. Now, this is what the banking system looks like, and this is very, very important, by the way. Let's understand this very clearly. So we have a bank, various types of banks located in various parts of the city or maybe within the country. Now, what is the typical way a bank does business? Banks takes deposits from consumer, right? Customers. Let me just put my laser pointer. Oh, I have the laser pointer already. Sometimes what happens is that it becomes very difficult to view where the mouse pointer is. And I think the laser pointer is lost. I don't know what happened. Anyway, so let's continue. Let's look at the mouse. You can see the mouse here. Customer. Now, customer is doing what? He has, let's say, 100 rupees. He is able to get from somewhere. He goes and deposits that money into bank A. Okay. Now, why is depositing that money in the bank? Because the bank is giving him interest. One. Second is that he wants to keep that money safe. Because if he keeps that money within his house, there is a likelihood of somebody can steal his money, or he might forget where he has kept the money. So it is better to keep money in banks. Both it provides security as well as it gives a certain amount of return to the consumer, right? Now, what happens is that once the bank has accumulated 100 rupees from consumer A, what it does is it will not keep the money static within his bank, because it will also like to generate returns on that investment or that deposit in order to do what? Pay interest to this consumer for his deposit, right? And on profits. That's the whole purpose of this bank. So what it does is, it keeps a certain portion of money which is being driven by regulatory diktat, which is called cash reserve ratio. Means, let's say if 100 rupees have been collected as deposit by bank A, then what happens is that 20 rupees, let's assume that the cash reserve ratio is 20%, 20 rupees he will keep in its bucket, right, as liquidity, and 80 rupees he is going to lend to some other consumer or somebody who wants to do business with that money. For example, I am as a customer or a businessman goes to the bank and says that, look, I need money to generate more, to kind of run a factory, to create products so that I can sell and make profit. So please lend me. So what the bank will do is that he will lend me that money, right? And that money which I'm going to lend, I'm going to put into my business on returns, and the rate of interest that the bank is going to charge me for that money that it has lent me will be higher than the deposit rate. Because if he is going to lend me money at the same rate at the deposit rate, then how he is going to generate profit? How the bank is going to generate profit? And what I am going to do is I have to earn more profit than what interest that I am going to pay to bank, right or not? Because the money that I take from this bank is going to be put into my business, and I'm going to run returns. I'm going to earn returns, and that return has to be higher than my ability to, so that I can actually have fully empowered to pay the bank the interest that loan will carry, and that is going to be my expense, right? So therefore, this is the way the cycle goes on. Now the problem is that the money that the bank keeps, right, which is a statutory requirement, which is called SLR, right, statutory liquidity ratio, that money has to be modulated in such a way that it remains optimal. So the bank has to evaluate every day, at the end of the day, how much cash that it is carrying. So when the next day starts, he has sufficient liquidity which has been held within his coffer, so that if anybody is asking for money or withdrawal of their deposit, it doesn't run out of cash. Because if the bank runs out of cash, then it kind of will impact the sentiment of the individual, and everybody will get scared, and whole population is going to go running into the bank to withdraw the deposit. The bank doesn't want to basically to default from the point of view of lending or giving back cash which somebody has deposited in their bank. So it has to keep a certain amount of cash at the end of the day and modulate that cash to keep it at an optimal level. Because if the end of day cash is higher than what is optimal level is, then what happens is that his ability to generate profits from that cash is going to decrease. If it is lower, then he is going to get into a mode of default, right? There is a risk of getting into a default. So that has to be modulated. So what banks do typically is they lend upon between each other. Let's say if this bank A, right, if he has to maintain a certain amount of cash and he's running short of cash, it will ask bank C, please give me a certain some portion of your cash, which suppose let's say bank C has excess. Therefore, I will like to replenish my end of day cash to a certain level which is expected for me to have in order to do a normal business operation the next day. That is called overnight lending. And this lending is governed by the Reserve Bank policy rates, right? And I'll explain to you how it is governed by the Reserve Bank policy rate. Normally, the lending is market determined. And why it is getting driven by the Reserve Bank policy rate, you will understand in the next portion of the presentation as I take you in the same slide. Let's understand. So first you have understood that the banks are lending between each other a certain rate which are market determined. Now what is happening is that if you look at RBI, which is sitting in between. So there are all these four banks which you see. There is RBI, Reserve Bank of India, sitting in between. Now Reserve Bank of India is the mother of all banks. All the cash, it has got the power to print money, right? Nobody has got the power to print money. Only Reserve Bank has got the power to print money. So what Reserve Bank will do is it will regulate the liquidity of the bank, that is indirectly, by regulating the interest rates at which it borrows money from, at which it lends money to these banks. Now, why would anybody need money from Reserve Bank? Let's ask this basic question, because you will say that, oh, I have banks, my peer banks to borrow money from, and I will do so in the market rate. So why should I borrow money from Reserve Bank, and why these rates, overnight rates, are determined by the rate of the Reserve Bank policy, right? So the reason is very simple to understand. Let's say if I am bank A, another you are bank C, you are running bank C, and we borrow and lend to each other, and we are doing so at a market determined rate, means I go to and check in bank B. Oh, by bank B, at what rate you are going to lend money? He'll say, I am going to lend money at, let's say, 5%. Then you go to bank C. Bank C will say, oh, I am going to lend money at 4.9%. Then you go to bank D. He'll say, I am going to lend money at how much? 4.85%. So instead of taking money from C or B, bank A is going to take money from D, right? Because that is the market determined rate. Now assume that everybody is trying to make profit, because if I am lending to some bank, I am going to generate profit because I'm not doing charity. I'm going to earn as much return as my overnight lending that I'm doing. But if I am not able to get a reasonable rate from any of the banks where I went to ask for money to replenish my overnight kitty, so that I can do a normal business operation the next day, I am going to, as a last resort, go to RBI and say, RBI, please lend money to me. So the RBI definitely will lend money to me at a higher rate, a slightly higher rate than what the normal rates will be, which I am going to get from the banks. But that rate will become the benchmark rate, because nobody will be able to charge higher than that particular rate which RBI has set as a policy rate. You understand now? That is the reason why the overnight rates of lending between banks are impacted by the RBI rate. If RBI sets a higher rate of lending, then whenever you go to any bank to ask for money, then the rates cannot be higher than that, because I have the option to basically borrow for RBI, because I am not getting if I as a bank is not getting a better rate. So that is how the overall banking system is controlled, and there are many layers of complexity associated with it, which I don't want to get into this video, because otherwise the video will become very, very complex. I want to make a point which we started in this particular slide, as to why RBI can RBI lower their interest rates at will? Because that is a very critical question that we have to answer, and for that all this background information is very important. Otherwise there is no point in doing this video. It will become very, very difficult for anybody to understand. So now let's talk about the various definition. This is important. Now there are different instruments, right? They are called bonds. Now what are bonds? Bonds are instrument used by government and corporates to borrow money. Let's say if government needs money to basically fund their fiscal deficit, it should issue a bond. And that bond is going to carry a certain yield rate. Means if I buy a bond, if the bond is at 100 rupees, I will get a discount, right? Which is going to be lower than the principal value of the bond, to a level that is going to be the yield. For example, let's say, if I buy a bond of let's say 100 rupees at a level of 97 rupees, then the yield of the bond is 3%. Because if I sell it at 100 rupees, then I will basically be able to make a profit of 3%. It's not exactly that, but just I'm making it up for simplicity. But that's the net concept. The corporates also do the same thing, and therefore bonds are pretty important instrument for borrowing. Now cash reserve ratio I have already explained in the earlier charts. What are policy rates? Which I have already explained, that rates which are set by RBI in order to control liquidity. Because when the banks are going to borrow at a higher rate, then their lending rates are going to be also increase. Let's say if I as a business go to the bank and say I need loan, the bank will say I will not be able to give you loan at, let's say, 6%. I will charge you higher, because my cost of borrowing has increased because of RBI's raised rates, right? That's the problem. Now, what is inflation? The inflation is the dilution of money. The money loses values as time progresses, and it will be able to buy less commodity, less goods and services than what it used to back in time. So you can say that there is an inflation, therefore more money is chasing less goods, or you can say that money has lost value in simple terms. There could be some complicated definition, but let's understand the simple definition. And what is expected inflation? Because this is also important to understand. The expected inflation is the inflation that we as an individual expect what will happen in the future, what kind of dilution of money will take place in the future, because what we are able to see is the current inflation. The future inflation, which we don't know, that we as an individual predict. Now, what is the impact of that prediction? The impact of the prediction is that our actions today is driven by what we expect the inflation to be in the future. For example, let's say if I am targeting a certain amount of expense in my company, and that expense is driven by my labor cost, my profitability, my revenues, etc., and I am basically foreseeing a higher inflation in the economy, definitely I am going to raise prices. My labor are going to demand more money, right, for the services that they are giving me, because nobody would like to earn less than what their money is going to lose value in future. So therefore, the action of the individual and the corporates, whether that action is positive, negative, whether it is going to raise the prices of goods and commodity, or depends upon the expected inflation. So therefore, most of the time, the Reserve Bank of India is actually doing something to give signal to the consumer or the corporates on the expected inflation. Because if you behave responsibly today, and if the government behaves responsibly today, and because of that responsible behavior, we as a corporate or a consumer believe that the inflation is going to go down, then we are going to demand less for our wages. Company is going to pull down the price. That will impact the real inflation. So it is important to give a signal to the consumer and the corporates that the economy is going to become stable, and therefore the managing expected inflation is extremely crucial. Okay. Now comes the other important points, that why short-term bond yields are impacted by RBI's policy rates, and why long-term bond yields are not. It is very important to understand this, because long-term bond yields are actually impacted by expected inflation, and the short-term bond yields are impacted by what? By the RBI policy rates. Why? You know that there are bonds that are of different duration. There could be a bond of 1 year, 2 year, 3 year, 4 year, 5 year, till the time of 30 years, right? Now, what happens is that when RBI sets the policy rates, these policy rates are typically for shorter duration borrowing. They are not for long duration borrowing, because there could be various instruments which RBI uses and the bank uses to lend and give money. Those are for shorter duration. Now, if I already have an instrument, let's say if because of that my FD rate, shorter FD rates are basically raised. If the bank, let's say if RBI policy rate is increased, bank also raises the FD rates, right? Now, why would I buy a bond, a shorter duration bond of a lower yield, if I am going to get a FD rate of higher rate from the bank? That's why the longer duration bonds yield has to match. Shorter duration bonds yield has to match in order to remain competitive, right? That is the reason why shorter duration rates of every instrument, every bond, whether corporate or government securities, are going to get impacted by the RBI's short-term rates. However, since long-term rates are driven more by expected inflation, if I invest, let's say, a 10-year bond or a 20-year bond, I am not a fool to invest in a bond at a certain rate, which is going to be a lower yield than the inflation that I am expecting in 20 years from now. Therefore, I am always going to basically invest for a bond with a higher yield. So that is why the yield of bonds which are of higher duration give an indication of what the market thinks of an expected inflation for that particular duration of time. And this is very, very important because this gives an indication of real inflation, and there is a phase lag between the bond rate and the real inflation. If both of them coincide, right, then economy kind of comes to a level of stability, but you will find that they don't coincide. There is always going to be a phase lag, and sometimes there will be complete dyssynergies. And if there is complete dyssynergy between the real inflation and the expected inflation, that is where the problem comes, because then economy never functions in an optimal fashion. Everybody is going in a different direction altogether, and we are not able to function optimally, and therefore it is very, very important to manage expected inflation. Okay. Now coming back to the last concept, and before I go and show you my data, that the RBI's policy rate can impact both real and expected inflation. It's very, very important to understand. That is why RBI doesn't have the handle to change the interest rates at their will. Why? Because there is a delicate balance between supply and demand, which you have to maintain in order to manage inflation. Let's say I have money in my pocket and I want to buy some commodity, and the supply of the commodity in the market goes down because of less economic activity, and therefore the factories were not able to produce that commodity to a sufficient quantity in order to manage my demand. Now therefore what will happen if less goods are being chased by more money? Then what happens? This delicate balance will get disturbed, and the value of the money is going to get eroded, and more money is going to chase less goods. Therefore inflation is going to increase. So therefore what happens is that RBI's policy rates actually impacts liquidity, and liquidity means less or more money with the hands of the consumer. So if you are going to control the money supply at the hand of the consumer, and if that supply has to be balanced with the supply of goods and services, which are kind of being a direct emanation of economic activity, the health of the industry, how the industry is investing and how the industry is growing, that will make the inflation stabilized. Means you will then have lower inflation. Okay. But if suppose inflation increases, right, because of more supply, what RBI will do? RBI will raise the rates. Therefore, which contain liquidity in the market, and therefore the inflation has to be contained. So if you have higher inflation in the system right now, can RBI reduce interest rates arbitrarily? You cannot, because you first have to contain the inflation and make sure that the inflation has been brought to a level which is much lower, so that not only the real inflation is getting impacted or getting lower, but also the expected inflation is also getting lower. Then only RBI can bring down the rates so as to trigger and spur the economic activity. If that is not going to be stabilized, both real and expected inflations are not stabilized, this is going to have a very detrimental impact on the economy, because of the real inflation is going to go spiral bound. Now probably you have understood. Now let's go and look at the data, real data, so that you understand where we are coming from. So let me give you the first data. We are going to talk about the impact of RBI policy rate on inflation, right? Or on the overnight term segment and liquidity facility adjustment rate. So what is the impact of policy rate on these rates? So if you see here, there are three blocks to this particular figure. The top is the overall volume of each segment: overnight segment, term segment, and liquidity adjustments facility segment. Now you don't have to get into the details what it basically means. Let's focus only on overnight segment for the time being. So these are the total volume of transaction which has happened in a particular month in that particular segment. Overnight means, we already explained, banks are lending to each other. Now if you see here, this is the RBI policy rate, right, which is called the repo rate. Repo rate means the rate at which RBI is lending to banks. Now you see that this is on a monthly axis. If you see the monthly axis, so when the repo rate was lower, can you see that the overnight rates are basically lower than the repo rate? I told you, the RBI will always lend at a higher rate than the market rates, because RBI wants to put a threshold. Normally, they will like the banks to lend between each other. However, at the last resort, they will lend this at this particular rate. As the rates have increased, see, these are also increasing. Okay, can you see it very clearly? Similarly, the term segments are also getting impacted because of this, right? So this very clearly for, let's go, I'll just go back in time by 12 months and you see that how this is basically getting, see, as the rates are getting lower, the interest rates are basically, the overnight segments are also getting impacted, directly correlated with this particular block, which shows the RBI's policy rate. And these are higher because RBI has increased their policy rate, right? So it's very clear. I don't want to basically spend time on this chart. Otherwise, we'll basically go very high in the video timing, right? Which I want to adjust. Now, this chart is a very, very important chart. This is the meat of actually the video. All that I gave you is to basically explain to you this chart. Now, let's understand this chart. I already did a LinkedIn post yesterday, but I thought that is insufficient, and that's why I'm doing this video. Now, what is this chart? This chart has got three different blocks. The block on the leftmost side is the repo rates, right? And this is quarter, right? Financial year quarters, various quarter and average repo rates. You can see this here. Then we have the inflation. Can you see inflation here? This is the total general CPI inflation here. And then this is the bond yields of various duration. 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 7 year, till 20 year, right? And these are the rates. Can you see one interesting thing? That when the policy rates of RBI were lower, the inflation was high. But the short-term duration of bonds, right, of the GSEC bonds, which basically government uses to borrow money, is lower. Can you see that direct correlation between the RBI policy rate and the short-term bond rate? However, the long-term bond rates, which are of a duration more than 10 years and 20 years, they are immune to the RBI's policy rates. Can you see that? These are all higher rates and the short-term rates. And that is why the government is so much concerned to have the ability to lower the interest rates, because if the interest rates are low, the bond yields which the government uses to borrow money, they also go low. Therefore, interest obligation of the government decreases. This is a very important factor apart from more money in the hands of the people, so that the economic activity also increase, so that the GDP growth can be increased. But this is a very important outcome, right? However, if you look at, so what I have done is that I have started this whole chart from the bottom of the time scale from FY14 quarter 4, and we are going up to FY24 quarter 4, right? So if you look at this, now if you see the overall repo rate at the initial stages were 8%, and slowly the rates were lower by the existing government. If you see that, it was very high. So what happened was that inflation was also very high in the initial stages, with the bond yields were also very high at the initial stages. FY15 till FY14, you can see both the short term as well as the long term bond yields were high. But then the inflation started cooling down. Can you see this? It is going down and going down. It has started cooling down, and the RBI actually started also reducing the rate. So RBI started reducing the rate in anticipation that the interest rate, the inflation is going to go down, and actually it did. You see, it is going down, and so what happened was, as the inflation went down, the bond yields are also got impacted. They also went down, right? So as you reduce your rates and you brought it very low, what you saw? So look, there is a very important, interesting thing to watch here. As you reduce the rate, the overall inflation went down, but you continue to reduce rates. You did it even when the inflation was very high. Can you see this? Till this time, FY20 the second quarter, the rates were actually being continuously lowered from 8.5. This is an average rate for a quarter, right? 5.94. Then it went to 5.252. The inflation was lower, 3.5%. Then the government continued to keep lowering interest rates, but the inflation went very high. And why inflation went very high? Because here, if you see in this chart, the expected inflation went high because of the high yield bond. So though the higher duration bond yields were low in this particular portion of the chart, but it went very high here. giving a clear indication that the market is seeing an expected inflation at a higher number, which kind of drove the real inflation also to a higher number. Can you see this here? Then what happened? Because the inflation went out of control, the government had no choice but to raise the rates in order to decrease liquidity in the system, right? So if you see here, the liquidity in the system got decreased, and what happened was that the bond yields, basically the policy rates were increased, that had impacted both the short term as well as the long term bond yields. So unless you contain the inflation to a very lower level and stabilize it, reducing the policy rates abruptly at the time when both the expected inflation, expected inflation is also high, and the real inflation is also high here, not very, very low, right? It is still higher than the RBI policy, the expected number of 4% and below. So you can't change the bank rates, because that will basically impact the liquidity in the system. It will increase, and if the supply side is not managed, your inflation is going to go spiral bound. It will have a huge negative impact on the overall economy. So I think you probably understood what I was talking about. This chart is very, very important to understand, which I again want to summarize. You see that the rates were lower, higher in the policy rates were higher in the initial stage, and then you started reducing it. The inflation was higher in the initial stage. The inflation went down. The policy rates were also lowered, and then you see the policy rates kept on lowering, but the inflation went high, right? Because the expected inflation went high here in this, very, very clear from the higher bond yields, right, of the higher duration bond yields, which clearly gave an indication that the market was seeing a higher inflation rate. And that actually resulted in a higher inflation rate. And then suddenly the government realized, oh, by the way, we have to we have to contain liquidity in the system. So I have to raise my bond rate in order to ensure that my inflation rate goes down, and it actually is going down, but still the expected inflation is very high, which is a clear signal that the market is seeing a higher inflation rate and in future. And unless that expected inflation goes down, this has got, by the way, it has got nothing to do with the RBI policy rate. It is driven by sentiments of the individuals. So what can RBI do now? RBI has to wait till the market inflation cools down, both the real inflation as well as the expected inflation, before it even start tinkering with the policy rate. If it start tinkering with the policy rate prematurely without making both the real inflation as the expected inflation at a level which the market believes that is going to stay and stabilize, putting down policy rates to a lower level is going to be very detrimental in nature. Very, very, it will impact the overall health of our economy. So this video has gone to 35 minutes, but I could not have helped. I wanted to do this video with a very detailed way, because I have taken really lot of pain to collect this data, to show you in real terms as to what the real data looks like. Because just going through the theoretical data and information in bits and pieces does not give any kind of understanding, because this is what the real picture looks like. And therefore, it is very important to understand what the government can do and what flexibility the government has to contain rates in future, right? It really cannot do it at its whims and fancy. It has to make sure that it does so with full consciousness as to what is going to happen in the future regarding both expected inflation as well as the real inflation. I hope that I have been able to convey my thoughts in this video, and probably you understood it. And I am sure that this might have been sufficient complexity, without getting into too much details. And many thanks for your time for watching this video in full and completion. And I'll come back to you with the next video next time. Thank you very much.